Are you in your 20s and struggling with managing your finances? If so, you're not alone. Many young adults face the daunting task of navigating the complex world of personal finance, often with little guidance. From understanding credit and tackling student loans to budgeting and saving, it can feel like you're trying to decipher a foreign language. The truth is, these financial hurdles are all part of your journey towards financial independence. And conquering these challenges as early in life as possible is crucial. Why, you ask? Because it sets the foundation for your future financial stability. Think of it as learning to ride a bicycle. Once you've got the hang of it, you're set for life. So don't fret. Every great journey begins with a single step, and we're here to guide you every step of the way. Stay tuned as we unravel the secrets to mastering money management in your 20s. Scene script. Ever heard of the saying, "A goal without a plan is just a wish"? This applies to your finances too. Just as an architect needs a blueprint to build a skyscraper, you need a financial blueprint to build your wealth. And the foundation of this blueprint? Budgeting. It's not about restricting what you spend, it's about understanding where your money goes and planning how to divide it to reach your goals. Now let's dive into what budgeting actually is. Imagine your income as a pie. Budgeting is simply deciding how you want to slice that pie. A piece for your rent or mortgage, a piece for groceries, a slice for entertainment, and so on. The key is to ensure that your income covers all your needs, some of your wants, and leaves a slice for savings and investments. There are several budgeting methods you can adopt, each with its own benefits. Let's explore a few. First, there's the traditional method where you track every single penny that comes in and goes out. This method can be time-consuming but gives you a detailed understanding of your spending habits. Next, the envelope method. Here, you allocate cash for different spending categories into physical envelopes. Once the cash in an envelope is gone, that's it for the month. This method is great for visual learners and those who prefer a tangible approach to budgeting. Finally, the 50-30-20 approach. This method suggests dividing your after-tax income into 3 categories: 50% for needs, 30% for wants, and 20% for savings or paying off debt. This is a simplified and balanced approach, making it an excellent starting point for beginners. Remember, the best budgeting method is the one that works for you. It's about finding a balance between your income, expenses, and savings and adjusting as needed. It's like a personalized roadmap that guides you towards your financial goals. So start today. Create your financial blueprint. It doesn't have to be perfect right off the bat. It just needs to start. Remember, a well-planned budget is your first step towards financial freedom. Now that you have a budget, let's talk about building that financial safety net. You know, that cushion that'll catch you when life throws a financial curveball your way. But how do you build this safety net? Well, there are a few strategies that can help you get there. First, we have the classic set aside a fixed percentage of your income. This is a tried and true method that works wonders. Start by determining what portion of your paycheck you can comfortably live without. It could be 5%, 10%, or even more if you can manage it. Remember, the key here is consistency. Make it a habit to set aside this portion as soon as your paycheck hits your account. Over time, you'll be amazed at how quickly your savings grow. Another strategy you should consider is building an emergency fund. This is a separate stash of money that you only touch in cases of, you guessed it, emergencies. It could be for unexpected medical bills, car repairs, or sudden job loss. A good rule of thumb is to have enough to cover 3 to 6 months' worth of living expenses. But don't worry if this seems daunting. Start small and build it up over time. Lastly, consider goal-oriented saving. This is where you save for a specific purpose, like a down payment on a house or a dream vacation. Having a clear, tangible goal can be a powerful motivator to keep you saving. But remember, the most important part of saving is consistency. It's not about how much you save, but how often you save. So whether you're setting aside a fixed percentage, building an emergency fund, or saving for a specific goal, stick with it. Make it a habit. Over time, these consistent savings will build your financial safety net, providing you with security and peace of mind. A strong saving strategy is your safety net in times of financial uncertainty. Credit can be your best friend or worst enemy. Let's understand why. Just as a hammer can build or destroy, credit is a tool that can either propel you towards financial freedom or plunge you into debt. It's all about how you wield it. Think of credit as a reputation with lenders. A good credit score signals that you're trustworthy, and lenders are more likely to give you loans with better terms. On the flip side, a poor credit score can limit your options and make borrowing expensive. So how can you use credit wisely? Firstly, avoid borrowing more than you can repay. It sounds simple, but it's easy to be tempted by the promise of instant cash. Secondly, always pay your bills on time. Late payments can damage your credit score. Lastly, keep your credit utilization low. This means not maxing out your credit cards. Remember, credit isn't inherently good or bad, it's a tool. Used wisely, credit can be a powerful tool in your financial toolkit. Ever wondered how to make your money work for you? Let's dive into the basics of investing. You've probably heard the term investing thrown around a lot, but what exactly does it mean? Simply put, investing is buying assets with the expectation that they will increase in value over time, essentially turning your money into more money. Now, when we talk about investments, we're not just talking about stocks, although that's often what springs to mind. There's a whole world of investment opportunities out there. Bonds, for instance, are like loans you give to the government or a company, and they pay you back with interest. Mutual funds are a way to buy a basket of different stocks or bonds all at once, which can be a great way to diversify your investments. And speaking of diversification, let's touch on that. Diversification is the practice of spreading your investments around so that your exposure to any one type of asset is limited. This strategy can help to balance out the risks and rewards of investing, because while one investment might be doing poorly, another might be doing well. It's a way to hedge your bets, so to speak. But here's the thing about investing. It's not a get-rich-quick scheme. It takes time, patience, and a willingness to learn. It's also not just for the wealthy. With the rise of online trading platforms, investing is more accessible than ever. Remember, investing is about making your money work for you. It's about using what you have now to create more for the future. It's about financial growth, independence, and security. And the best part? You don't need to be a Wall Street whiz to get started. All you need is a little knowledge, a bit of courage, and a plan. Investing is not just for the rich, it's for anyone who wants their money to grow. Finally, let's address the elephant in the room: student loans. Unavoidable for many, they can feel like a daunting mountain of debt. But don't fret, with a well-thought-out plan, this mountain can be conquered. Firstly, understand your loan. Know the interest rate, the repayment period, and the minimum monthly payment. This knowledge is your compass in the journey of repayment. Secondly, consider loan refinancing or consolidation. These are not scary financial jargons, but tools that could potentially lower your interest rate or simplify your repayment process. Refinancing is replacing your existing loan with a new one that has better terms, while consolidation combines multiple loans into a single one for easier management. Lastly, prioritize paying off your loan. It may mean sacrificing that fancy coffee or weekend getaway now, but the peace of mind later is worth it. Remember, student loans are a hurdle, not a life sentence. With the right strategy, you can overcome them.